All right, well, Citi's head of equity trading strategy recommends going long high-quality stocks right now. Stuart Kaiser is behind the call. Stuart, great to have you with us. Nice to see you.
Good to be here.
We're talking about tech all-time highs once again, as if last week never happened, as if a trade war never happened, as if a conflict between Israel and Iran isn't happening right now. What do you make of this market move?
I mean, I think the recovery today is just reassurance to the market that basically if oil doesn't dislocate to the upside, equity investors seem largely comfortable to kind of ignore some of the geopolitical risks, whether that's Russia and Ukraine, whether it's Israel and Iran. I mean, that was the case other than, call it, a couple weeks in March 2022 when you got oil up to like $120. Generally speaking, I think investors say that's the channel through which we're going to kind of handicap geopolitical risk. And since we didn't see that follow through today, markets kind of recovered, vol came in, and we're kind of back on the march higher.
So how do you think about high-quality stocks? What are those, and what kind of environment are you bracing for?
Look, I think our view here is the setup for equity sounds a lot like it did at the beginning of the year, right? Which is earnings growth looks okay, valuations very high, positioning looked quite long. You have attendant recession risks and a lot of headline risk as well. And in that environment, yeah, we want to be long U.S. equities, but we want to do it in a more conservative, high-quality way. What's kind of changed for us is we like growth coming off the bottom. When you get those long end yields moving, the growth trade feels a little bit under threat. So we kind of rotated out of growth into quality as a result of what's going on in the interest rate market.
Stuart, you mentioned positioning and length. And I'm just trying to understand where your clients are. I mean, you're in the middle of the institutional world. You're talking to the biggest hedge funds in the world. You're talking to me. I get the sense that, if anything, they had really pulled back exposure. It wasn't the retail community that had changed a whole lot in terms of their MAGA view, but that there's no question that the directional, the long-short community. Any thoughts on that? Are they still, underweight where they were, 6 months ago, or do you think they actually have really turned it completely to full long as they have been?
Yeah, I think we'd probably put positioning 7 out of 10, probably a little less heavy than it was in late February, but significant recovery in positioning. Long short hedge funds, I think, got hurt a little bit in the initial 10% drawdown, call it from mid-Feb to mid-March. They got their risk right, and I think we're actually able to play a little offense, coming off the bottom. The second 10% drawdown kind of got your macro directional guys a little worse, so they've been kind of a little bit later to reengage. So positioning is pretty full. It's probably not where we were in mid to late February, but
it's not underweight. Got it.
Yeah, you're getting pretty close.
When you talk about real high-quality companies and great balance sheets, where is energy? Where does that fit in? Because I thought that the move in energy down only $1 and change off the heels of what's been happening was pretty strong.
Yeah, I mean, energy would not probably be right in the core of the quality stocks. There's probably a few that would put you in there. I think what happened to energy today is effectively, yes, we didn't get the short-term rip in oil, but it does seem like this risk is going to kind of be persistent and ongoing, and maybe the market's starting to assume maybe you'll get those longer-dated futures a little bit higher. Energy is definitely an under-owned part of the market, as you might imagine, structurally. So I think what you're also seeing there is a little bit of positioning kind of getting forced into the market, whether it's short covering or kind of right-sizing yourself, because look, I mean, that's been a structural laggard for a while. So I think it's a little bit of positioning and a little bit of concern. This might kind of linger for a little bit in the market.
The weaker dollar's been a tailwind. At what point, though, has it become a concern? Because there's no bounce in the U.S. dollar.
Yeah, I mean, it's concerning to the extent that it's volatile, because it does kind of speak to this U.S. exceptionalism is dead trade. Frankly, that trade was much more loud and vociferous until about March, and it's kind of calmed down. 1Q earnings really changed things for us. I think when hyperscalers, to your point, doubled down on this CapEx spend, it convinced institutions and I think foreign investors that they were underweight the AI trade, as kind of comical as that sounds. And the bottom line is you can't have the AI trade on in the size and depth and liquidity you need without being in U.S. equities, right? So I think that's kind of pushed people back in the market. So for now, with where the dollar is, I think you're okay. Investors, obviously foreign investors, it's a big impact for, and I think what you're seeing there is they're hedging a lot more of their dollar risk than they have in the past. So as long as we're under control, I think you're okay. But to your point, it is a headwind, particularly for foreign investment flows.
Stuart, banks, BKX, has not really gotten as close to the highs as the S&P 500. KRE, regionals don't act particularly well. And then if you look at all of these kind of, whatever you want to call them, Apollo, KKR, Blackstone, they actually do not trade well off the highs here and really off the lows, actually. What do you take from that price action in general?
Look, I think banks were a little surprised at. The deal calendar does actually look like it's picking up a little bit. The Circle IPO went pretty well. It looks like a little bit of regulatory relief. So banks trade is still something we like. On Friday, I think the stablecoin news coming out of the retailing side kind of put a little bit of pressure on fintech and some other parts of the market. So it could be that banks has been kind of a consensus long, so they're not getting sort of the incremental flows coming in. But yeah, a little bit surprised, frankly, that space hasn't performed better. We still do like the large cap banks. Regional banks are a little tricky because that small cap, lower quality trade is just really lacks sponsorship. So it's a little bit hard to like that. But larger cap banks, it actually seems like a pretty good operating environment for them right now.